Stocktake is brought to you by Intelligent Investor, Australia's leading value investing research house. Get your free trial by heading to intelligentinvestor.com.au. The information in this podcast is current on the day of recording. It is general advice only, does not take your personal situation into account, and may not be suitable for you.
Welcome to Stocktake from Intelligent Investor. For a free trial, visit intelligentinvestor.com.au. Good morning, my name's John Addis. I am the founder of Intelligent Investor, and I have with me here today analyst Gaurav and analyst Nick. And we're going to kick things off with a multiple choice question. People might see this as juvenile humour. I would see it as satire, just a warning to you two. So question one, if President Xi is playing poker, is Donald Trump playing A, Uno, B, rock, paper, tariffs, C, doctors and nurses, or D, with himself as everyone else watches? Too obvious. It's too obvious. Let's try another. Question number two. Does the figure 79% relate to A, how much China's tariffs were reduced 5 minutes ago, B, the price increase of the next iPhone as projected by UBS, or C, how much of Bill Ackman's body has disappeared up someone else's rectum? That's one of the many weird things about billionaires, is how quickly they're willing to debase themselves for even more money. So any guesses?
Can I just preface the guess with, I'm so glad that everyone gets to hear the true John Addis. And this is what we as analysts have to come up with in the office. Anyone who has to excuse their juvenile behavior with calling it satire.
Okay, so let's have a guess then. A, B or C?
I'll go B.
It has to be C. We all know it.
Yeah, you're both wrong. They are all true. And that's because we're an absurdistan. That's where we are now, I think, where idiocy reigns. No one has a gumption to say no, because sycophancy and loyalty are the defining characteristics of the US regime. It seems to be squandering its power. It's turning the world against it. It's beginning a trade war with China. I think it will lose. And just because someone wants to bring jobs back to the US that no one wants. That's our subject today. How do we invest in the emerging market of absurdistan? Now, the even weirder thing about absurdistan is that despite all the chaos, stocks didn't even get broadly cheap. Nick, let's start with you. Why is that?
Yeah, well, I don't know. I can't explain why stocks didn't get broadly cheap, other than the fact that Trump, turned tail and ran after problems in the bond market. But I think we've come from a point that markets were very expensive. There was that huge run-up last year when Trump got elected. Investors were very excited about deregulation, tax cuts, and a more friendly business environment, and sort of animal spirits took over a bit. And I think it's one of, or if not the most expensive US markets in history as we started the year. So markets were really priced to perfection. And they're only sort of off now that they bounce a little bit, probably 15%, or maybe closer to 20%, but probably about 15% from their highs. So they're coming from the highest point, one of the highest points in history, and only falling 15%. That's not cheap. There are pockets that look cheap and have fallen far further, but 15% isn't a screaming buy, or there's no screaming bargains yet.
I'd also say that the last crisis was only 5 years ago, and these are supposed to be once in sort of generational downturns, but they're now happening every couple of years, and it means people's muscle memory is being flexed. 5 years ago, everyone was rewarded for buying the dip, for not panicking, and for leaning into the crisis. And I think that that experience has informed today's reaction. So lots of people, the fear was somewhat limited, and many investors, especially retail investors, took the opportunity to buy. I'm not sure that is the entirely right reflex. There are some parts of the market that are still absurdly expensive. There's still all the problems we saw before this still exist now. Lots of crowding in a handful of names, stupidly high valuations, and a market that's really driven by only a handful of names, and those names have to get cheaper.
We saw big falls in Pro Medicus, Goodman Group, NextDC, they're still nowhere near our buy price. Where were the pockets of opportunity, Gaurav?
Yeah. So, yeah, I don't know how much I want to say about what I've been buying, but the really, really cheap stuff is now in cyclicals, I think. So energy is just remarkably cheap. It was cheap to begin with, and it's become even cheaper. And I think some specific US companies with American operations were hammered, and some of them unfairly so. So there are, if you do your work in the US exposed equities area, I think you'll find some good bargains. And then if you look on our buy list, there's a couple we upgraded for specifically for that reason, the fact that they've been hammered and yet they look quite robust. So those are two areas. There's also, I still think these high cash flow, dividend paying traditional value stocks in these asset heavy industrial names. These companies have not been caught up in the tech madness. I wonder if the social media might have something to answer for here. Everyone is looking for the same style of stock. This high ROE, asset light, high growth, high alpha kind of return, and those are the qualities that have been rewarded. So anything that is anti that, so we're talking capital intensive, high capex, a little bit cyclical. These aren't the highest quality businesses, but the prices are now so attractive that I think we're at a spot where we can generate good future returns.
It's definitely a place where very few people are looking. What about you, Nick, where you did make some upgrades last week? You cover quite a few US stocks. What's your view on that market and where maybe we'll find some opportunities?
Yeah, I tend to agree with Gaurav that those typical value names now look like the ones that you sort of want to potentially rotate to. A lot of the high PE stocks, particularly in the US and even in Europe, they have fallen, but probably not enough where you're starting to get excited. Amazon's an interesting one because that is one we've added slightly to. Everyone sort of knows the business. It has the e-commerce arm on one side and the cloud computing business on the other. That's fallen now 30%, which isn't a lot. Like it can fall further, but it's also growing its earnings at sort of 10, 15, 20%. So, or has done over the last couple of years, and we think it can going forward. So if you look at a 30% fall plus, you add a year on and earnings are going to be potentially 10 to 15% higher, that makes a huge difference in valuation. So that's one that now trades at its cheapest multiple ever.
Wow. Okay.
And particularly on a cash flow point of view. And again, a preface, that was when it fell, not today. So that was one, but there's not broad buying opportunities. The one market internationally that I think is very, very cheap and has been for the last 6 months is the UK. And it's not just value stocks over there. Yes, their banks are cheap, and there's companies like Shell and BP, the energy companies that Gaurav is referring to. But there's world-class businesses over there with capable management teams, high returns on equity that are trading at 20 times earnings, where the equivalent in Australia is trading at 40 or 45 times, or the equivalent in the US is trading at 40 and even sometimes 60 times. So there's some really, really good businesses over there, and that market looks very, very cheap. And most of the ideas and most of the research I've been doing lately has been on companies listed there, not necessarily with all their earnings in the UK, but companies listed on that exchange.
I was very excited when Nick called me up and said, "Have you heard about Greggs?" and Greggs sells bakery products, which people really like after a big afternoon drinking session. And I said, "Yeah, I definitely heard of Greggs." Even that company sounds quite interesting. It's a rollout story. I asked some friends in the UK who are investors, and they said, I don't know, But when you look at the number of stores it's got and what it's trading on, it's quite an interesting kind of story. So I'm looking forward to reading more about that. I do have a note here saying that to remind people of Peter Lynch's quote, that if you spend more than, if you spend more than 13 minutes thinking about macroeconomics, you've just wasted 10 minutes. We've got 15 minutes left, and we might have to break that rule. and the reason for that is what Trump has done in the last 3 months it's quite something. Like, it's crashed the stock market. He bought the bond vigilantes out in a sort of Liz Truss style lettuce event. So there was a bond crisis, which seems to be the only place where he's found any opposition. He's forced an international realignment. He's even got the Germans to retreat on their constitutional debt arrangements so they can spend more on defence. And he's pushed China and Japan and Korea closer together. I think the UK is even talking about closer relations with the EU now, which politically has been sort of impossible to do over the last 5 years. It's an absolutely astonishing change of events in just 3 months. We've got almost another 4 years of this. So can we just talk about the US, and let's have one of you make the bear case for it and one make the bull case for it.
Geez, the bull case. I don't want to take that. That's going to be hard to make.
I'll take the bull case if you want.
Yeah, I'll take the bull case.
Oh, no. You're going to take the bear case.
Not a chance.
Okay, make the bull case, Nick.
Okay, so I think the bull case, there's probably two aspects to it. One is, this too shall pass. Maybe the craziness over the last 3 months has been front loaded, and Japan and the EU and all these other trading partners with the US come to the table. We get some trade agreements. China eventually comes to the table. And maybe even Trump in the midterms in 2 years, his power, maybe there's a poor showing there, and the power that he has now is less. So that's the first one. I think that's probably a little bit unlikely, to be fair.
Why is
the
that?
Second, well, I just don't see all these countries coming to the US making a deal that he's happy to sell back to the American people, and that they're happy to sell back to their own constituents. I think that's very unlikely for dozens and dozens of countries to be able to do that. So I think there's going to be a fair bit of friction there, but also this is a big opportunity for China and other countries to try and say to these once allies of the US, to maybe you should hedge your bets, maybe you should come and do more trade with us, and we can we'll treat you more kindly, all the rest of it. So I think that's a real possibility. The second point of the bull case is this is mainly from an investment point of view, that the US still remains probably the best house on a bad street. and what I mean by that is when you invest in the US, as a shareholder, management and the board's only duty is to create or maximize shareholder value. So you know exactly where you stand. You are the only key stakeholder. Whereas in Europe, even in Australia to an extent, but particularly in Europe, there's other stakeholders like employees, the environment, government, suppliers to consider, and they're all important. But from a shareholder's point of view, maximizing shareholder value is really what you want. If you look at a country like Germany, it has a two-tier board system where they have a management board, which is the executives, and a supervisory board, which if a German company has over 2,000 employees, half of those board seats for the supervisory board have to be employee representatives or union officials. And they make important decisions like mergers, who's CEO, and then the long-term strategy of that company. So it's pretty hard. It introduces a lot of bureaucracy into sort of the corporate culture in Germany that you just don't have in the US. It's still far easier to create a business in the US than it is in Europe for regulation reasons. and lower taxes, all that sort of stuff.
Yeah.
The other point too is it's there's 330 million consumers in the US. They speak the same language, they have the same culture, and they pay in the same currency. In Europe, completely different. So it's far easier to grow a business in the US and take a business, let's say, from Washington State to Ohio than it is to take one from Portugal to Finland. And that draws in a lot of talent, a lot of entrepreneur talent. 8 out of the 10 world's best universities are still in the US, so there's a lot of foreign students still coming there, and that's obviously a danger now. If the end of them, or if the narrative around the American exceptionalism, if that were to end, that would be a real problem for them. But for now, I think it still holds, and I think that's probably the bull case.
Yeah, it's that truism that has been true so far, which is you don't want to bet against the American entrepreneurial spirit. What about you, Gaurav? What's the bear case here?
Well, the brand of the USA has been irreparably damaged. And I think most of the craziness is confined to this specific administration. But even after this administration passes, if it passes, and I think that's something that no one's actually saying, that there's a non-zero chance that that Trump seeks a third term. The damage has been done. Trust has been lost. Relationships have been broken. And when one party chooses to go unapologetically extreme, often extreme is rarely met by moderation. Extreme is almost always met by another extreme. And I think that damages the entire political spectrum. So I don't think you're going to have, assuming Trump goes and we get a new Republican candidate, will we go back to the sensible Republicans of old? And it's amazing that we're calling George W. Bush sensible at this time.
Yeah.
Or do we get another a MAGA acolyte? And what kind of person does that attract as opposition from the Democrats? So I think the craziness is probably just here now. And I think the US dollar as the reserve currency, those days are numbered. The market's telling you that by what's happening in gold. These are extraordinary moves. Gold is heavily underowned, and it's still at record territory, and most fund managers don't own a piece of it. Yeah. And I think that tells you that countries are worried about the US dollar. They're taking their money out of America and they're putting it in other assets. The days of American financial hegemony are gone, and it's amazing how fragile that strength really was, because I think it's been cracked and now permanently broken.
So this is Gaurav talking in the past tense about the future, which is, I think they call that a forecast, don't they? I think this is one of the things about this situation is that it's hard for our brains to comprehend such a rapid change in circumstances in a nation that's generally done most things pretty well, has been quite sensible, has established itself as an imperial power, but without much of the ugly connotations of previous sort of colonialisms that we've had, largely from Europe.
But John, this has been a long time coming. This is not...
Oh, yeah, I know that. I think you could trace this back to, I don't know...
Tea Party stuff? Yeah, that's right.
Before then, when Newt Gingrich took over, became prominent in the Republican Party, and they decided that they were going to just start voting against Democrats just to delegitimize them rather than voting in the interests of the country. I think I would trace it back to that kind of period. There's obviously a lot of other stuff going on there. We're not political experts. We're not even macroeconomic experts. But I do think it's important for investors to understand the range of possibilities that America now faces, because just a few years ago, they were kind of inconceivable to most people. America, it could be the new Hungary. It could be the next Turkey, or it could revert to where it was 20 or 30 years ago. We just don't know. But it does mean that there's more risk there. And when you look at the multiples that people pay for US stocks, there tends to be a US premium, and it doesn't look as though that US premium has really disappeared to me, Nick. What would you say about that?
No, it hasn't. There certainly is a premium that you pay for US businesses. Look, and we've had internal discussions, or internal debates about this, John and I. I would probably argue a lot of that is just that the average business on the US exchange is far better than your average business on the Australian or the UK or Japanese markets. And if you look at our largest business, I think it's still CBA. It might be BHP. Gaurav might be able to correct me, but I think it's still CBA. And I think their largest one at the moment is Microsoft. And I think Microsoft deserves a higher multiple than CBA, and that makes sense to me because it's a far better business.
That's the best joke we've heard all podcasts there, Nick.
Yeah. So no, I think some of that multiple is deserved, and if you look at it, going back until about the year 2000, between 2000 and the GFC, European companies actually return on equity briefly took over American companies, and that was mainly their banks were doing quite well. Obviously, that all changed, but now the gap between American and European companies in terms of return on equity is about 5 percentage points, and with Japanese companies, it's about almost 10. So it's a huge difference, and one group obviously deserves a high multiple. Now, I guess the debate is about how high that multiple might be. But if what we're talking about here, that the risks of investing in the US have increased, well, the natural follow-on to that is investors should want a higher return, and they'll want greater compensation for taking that risk. And we're not seeing that yet at all. There's still a premium on these US businesses.
Yeah, and I think the consumer is really under pressure there. None of the signs are good. Plenty of people expecting higher inflation, maybe even stagflation. Small businesses are terrified of what might be to come.
Well, that's why this crisis is different. I remember sitting around. We had a meeting at II meeting the day the market hit its low in the COVID crisis. And Hoff, who was running our session that day, said, if you're not going to buy it today, like, what do you need to see to buy it? I think all of us went out that day, coincidentally on the low, and bought stock. Yeah. And we did that believing that even though the market was incredibly uncertain, we had a huge problem, that smart people, policymakers, scientists, everyone was working together to solve the problem ahead of us. This time it is different, because this time the problem is the policymakers. No one is coming to the rescue. No one is solving this problem. The guys who are supposed to solve it have created the problem. So it is different this time. That faith I had in 2020, the confidence I had to go out and buy stock, it is not there today. I have bought a little bit during the crisis, but not nearly as much. If you had told me the market would be panicked and down 15, 20% in 3 days, I would have thought, I'd be in there buying on a day like that, and I just wasn't.
Yeah, I think that Peter Lynch quote doesn't apply in these circumstances. I don't think it really applied in the GFC either. You had to pay attention to those circumstances, and you can't really predict. We shouldn't be trying to work out what's going on here, but we do need to recognize a range of possibilities and act accordingly in terms of how we allocate our portfolios, what levels of cash you've got, and what kind of stocks we're buying. So let's just close with that. How are you approaching this in terms of your portfolios and the stocks that you're interested in? And what are the things that you're watching out for?
Well, the stuff I've topped up on has been the stuff that's been ultra cheap. So I'm not buying the stuff that's fallen the most. I haven't touched Pro Medicus, WiseTech, Xero, Goodman, Tech One, all those high PE, high growth stocks that we warned people about, saying everyone's crowded into these stocks. This is a dangerous time to be owning them. I haven't bought any of those. I've still been focusing on high free cash flow businesses trading on low multiples. And that's where I've been buying. So that includes stuff like cheap car dealers. There's one on the ASX that's below asset backing. I've been buying that. I've been buying energy companies. And I bought some mining services companies. And I don't think the only high quality business I'd nibbled on was I bought a little bit of Pinnacle, added to my position. It's a large position for me already. So I just added a little bit to that. But apart from that, it's these traditional value stocks. I've suddenly found myself being an old school value investor.
Value's back. Nick, what about you?
I haven't really bought anything apart. Like in the portfolios, I mentioned that we've increased Amazon, but we haven't made too many major changes. I think what I've been more focused on is just working out what businesses I consider almost funding businesses. So businesses that I'm happy to sell, and then when the time comes, rotate into some of these either higher quality businesses or companies you want to own for the next decade. So like there's some classic examples in the Australian market over the last sort of fortnight. So like Coles, Woolworths, Telstra. If you have these in your portfolios, I think these are great funding positions.
Yep.
Do you want to explain what that means, Nick?
Yeah. So a funding position is usually one where a defensive business that doesn't fall as much as the market, but obviously doesn't have as much growth on the when the market sort of rebounds or as much return potential. So Coles and Woolworths were classics last week. They're not that affected by tariffs, if at all. They're completely domestic Australian focused businesses, and everyone's got to go to get their groceries every week. So the stocks are pretty much flat. Telstra maybe fell a little bit, but not too much. Whereas some of these other businesses, like as Gaurav mentioned, WiseTechs, Xeros, they were down 30-40%. Or have been off since their results at least. And if those companies hit your buy price or price you'd like to acquire it at, and they haven't for us, but if they do, I would look to some of these businesses like Woolworths and Coles in your portfolio, to potentially rotate into some of those sort of high quality growth names, and that's what I've sort of just been preparing the portfolio for. So we haven't shot too many bullets. We're sort of preparing for this to be pretty volatile for a little while. I don't think this was the big fall and now we're out of the woods. So I think you want to be careful that you don't shoot all your bullets. Whereas I thought, Gaurav made the point before, like during the lows of COVID, I thought the moves back then and there's the ferocity of them. I mean, some businesses were off 90% within 3 weeks. I thought that was a time where you could shoot a lot of bullets. Whereas now I don't think is that time.
Yeah, no, I agree with that. I mean, we have a high quality hit list with about, I think, 27 stocks on it. I don't think we managed to upgrade any of the stocks on that list during the last 2 weeks. We got close with a couple. Actually, no, we did upgrade 1, 2, but we got close with a few others. We're still not there yet. This is a really difficult environment. I think my comment would be that there isn't really an adult in the room in the share market, but the adult in the room in these circumstances is the bond market.
Yes.
If you're going to obsess over anything, watch the bond market, because even Donald Trump's looking at that and reacting to it, even though he's not admitting that, but I think it's pretty obvious that he is. Watch the bond market, and again, watch out for debt. In these kinds of environments, any company that's carrying a lot of debt is potentially facing more risks than they would have done in environments where there's more stability. So that's how we're playing it. We're expecting this to continue. We could see some really good opportunities down the track. I don't really want this to continue, but but it could be good for investors down the track, especially in ASX-listed stocks, like you say, Nick. So that's where our focus is going to be. I think we'll call it a day there. Thanks very much for listening. For a free trial, once again, visit intelligentinvestor.com.au, and we'll be back in a couple of weeks.